If you locate a dollar in your portfolio, we need to figure out when you need access to that specific dollar in your portfolio, and then we can tell you how much risk to apply to that dollar. So it doesn't matter. If we have $1 million portfolio, every single dollar within that portfolio has a job to do. You are going to need access to that dollar at some point. If you need access to that dollar in your $1 million portfolio in the next 10 years, that needs to be invested differently than the dollars in your portfolio that you don't need for 20 years.
Right. The 60-40 you said is dead. I agree. We think it's dead because there's correlation in the markets now. It is at an all-time high between stocks and bonds. And you simply don't get the hedge from that bond side of the portfolio that what it's designed to get. And we don't know that that will ever come back and change again. So from a financial planning point of view, the rules have changed. We have to change the way we go about doing them. So my advice would be, if you are working with an advisor and you are still in a 60-40 portfolio, you should ask why, right? Why? There might be a legitimate reason. I'm not saying that it's always bad, but why are you still in that traditional 60-40 portfolio if it doesn't really provide you the protection that it used to? Welcome back to another Friday here at Family Wealth Planning Partners, where we are doing the retirement planning happy hour. Is that what we're calling it?
That is what we're calling it.
We're going to go with that. I like that. See, it's Friday around here. You just never know what you're going to get. My name's Chris Vaughn. This is my partner, Eric Douglas. We're kind of shaking it up a little bit today from our normal format because Eric came up with a great idea earlier this week that I'm going to let him just go down the rabbit hole. So I'm going to get things started, and I'm going to talk about the bourbon first. But we're going to do the bourbon differently this week, too. Normally, it's just, I bring in a couple things from my personal collection, and Eric says, I want to do that one, and that's what we do. But today, we decided to use an analogy. So we're using Maker's Mark. If you're familiar with Maker's Mark, this is one of the standard brands that's been around since time immemorial, right? Mm-hmm. There was a point in time where it was impossible to go into any bar anywhere in this country and probably most of the world and not see Maker's Mark. Well,
especially if you go outside of the state of Kentucky. Maker's Mark is, you get Maker's and Jack and a few other standards.
It's synonymous with bourbon. So the candle wax on the bottle, for the covering, this is something everybody's known. But what we thought was interesting about Maker's Mark is they only have one mash bill. For those of you who don't know, it's a wheated mash bill. Wheated bourbons have a little bit of a softer mouthfeel. They don't have as many spicy notes. Some people like that, some people don't. The Pappy Van Winkles that are so famous, those are also wheaters. But what happened to Maker's Mark was the world started to change, and they didn't. They just stuck to that one mash bill. They stuck to the one shaped bottle and their candle wax, and that was their thing.
And to be clear, when we say the world changed, we specifically the bourbon
industry, world changed. Yeah.
The bourbon world changed. Yes.
And for example, those of us who are bourbon drinkers, our palates changed. We got exposed to new flavors and ways that people were making bourbons, and Maker's Mark just became boring. Right?
It just kind of got left behind a little bit.
It got left behind. It didn't change. It was the same thing it had been since, the 50s, 40s, whatever it was. They didn't really change anything, but that was the problem. Because they didn't change, they started falling behind. There's a quote, if you're a college football fan, God help me, I'm a college football junkie. There was, and his name just popped out of my head, the head coach at Florida State for many, many years.
Bobby Bowden.
Bobby Bowden, thank you. See, it's Friday. You all know how this is. I'm not a Florida State fan by any stretch, but Bobby Bowden was a class act by all measurements that I'm aware of. And I heard a quote that he made one time, I have nothing against change because I like to win too much. And it's like, wow, what a profound thing to say. So Maker's Mark kind of looked at that and said, yeah, we're losing. We need to start winning. So they have started doing all kinds of stuff. They still, to my knowledge, just use that one mash bill. But they're doing a lot of different things with it. What we're trying here today is their wood finishing series. Now, they do these, it's really kind of interesting. They have 5 different wood staves that they've come up with, and they are Baked American Pure, Seared French Cuvée, Maker's Mark 46, which is, I know that's a French oak. Roasted French Mendiant, I have no idea if I'm saying that right, and Toasted French Spice. So here's the deal. Your company or your liquor store, whatever, you go to Maker's Mark and you pick 10 staves. You have to do 10 of them. Of any combination you want, and my understanding is there's 1,001 different combinations, but you pick the flavor profile that you want, and they make a limited amount. So this one, it's 34210. If you were to look at the bottle, there are only 246 of these bottles in existence that are this exact combination, picked by this. It's called Real Deal Holyfield. I have no idea what they meant by that. But this is one that Liquor Barn did.
It's probably a name of like GM or somebody over at Liquor Barn,
probably,
or whoever was instrumental.
It's probably not the boxer that pops in my mind.
It's spelled differently.
Yeah. So anyway, it's 108.1 proof. This particular one was done in May of 2022. I have no idea what this tastes like. I've had many of these before.
I just tasted
but we cracked this one open just a couple minutes ago. I haven't tasted it yet. And that's kind of our theme today, is that if you don't change, you become less and less relevant. So while I start tasting this bourbon, Eric, why don't you start going into what we were talking about, what came up to your mind the other day that kind of drove this change idea?
So I came across a chart, and we'll make sure that we put it up on the screen so everyone can see it. But basically, it's a chart that's showing the correlation between bonds and stocks, right? And in most traditional portfolios, going back to however long you want to go back in market history, right? Most traditional or most conventional wisdom, I should say, is you want to have a mix of stocks and bonds within your portfolio, for good reason, because the idea is when stocks zig, the bonds are going to zag. So you want some type of hedge or some type of protection within your portfolio that's built in to generate some type of a downside protection, right? Mm-hmm. Some type of protection against general market volatility, market crashes, whatever you want to call it, right? So when the stocks go down, the bonds either go up or at least at a minimum hold their value. And we've had conversations before, and we've done episodes around why the 60-40 moderate portfolio is dead. For those that don't know, I'm sure most people probably do, but the 60-40 portfolio is kind of the standard bearer in our industry as far as portfolio allocation, asset allocation is concerned. 60% stocks, 40% bonds.
And most people call that a moderate
portfolio. It's a moderate portfolio. So, moderate risk allocation. You're not too terribly aggressive. You're not too terribly conservative. It's kind of, what's the with the three little bears or whatever, it's just right. Yeah. So you get that a lot, right? And that's kind of the standard bearer type of asset allocation portfolio within our industry. And it's been around, much like original Maker's Mark, it's been around for a long time. And quite frankly, just like Maker's Mark is a very good bourbon. We're not saying anything bad about bourbon. It's not high level. It's not top shelf, but it's good. Great, and mix it with Coke. If you need a bourbon and Coke,
don't. Oh,
I haven't had a bourbon and Coke in a really long time. But if you're at a bar and you need a bourbon and Coke, it mixes very well with Coke, and it's a great drink, right?
Yeah.
It's something you can mix. You can drink it on its own, but by no means is it going to be any type of a top shelf bourbon.
Yeah.
And that was the issue that Maker's Mark was having. In a world where the bourbon industry, the bourbon world was expanding, and everyone was trying all these new things. Maker's Mark didn't get worse. There was just a lot of other things that were getting better, right? And so I came across this chart and just kind of hit home. It just helped expand upon the idea that we've talked about, especially with our clients, how the traditional 60-40 portfolio, quite frankly, is dead.
It's dead, yeah.
The idea of a 60-40 portfolio is very much alive. Okay? The idea that you want to have some downside protection, you want to have some diversification against market volatility, you need that downside protection in your portfolio, that idea is still very much alive. Okay? So when I say the 60-40 portfolio is dead, I'm saying the traditional way of implementing a 60-40 portfolio, that way of thinking, that traditional way of implementing that is dead. Okay. Or at least has been improved upon.
Okay, so before you go too far down that road, let's explain to everybody when you would typically use, historically, a 60-40 portfolio. This is not something that you would use with a client who's in their early 30s for their retirement funds, for example, right?
Absolutely. So, the idea, because you want to build diversified portfolios, of course, but if you're younger, it all goes back to timelines, right? So tell me when you're going to need access to your money. And even get more specific than that. If you locate $1 in your portfolio, we need to figure out when you need access to that specific dollar in your portfolio, and then we can tell you how much risk to apply to that dollar. So it doesn't matter. If we have $1 million portfolio, every single dollar within that portfolio has a job to do. You are going to need access to that dollar at some point. If you need access to that dollar in your $1 million portfolio in the next 10 years, that needs to be invested differently than the dollars in your portfolio that you don't need for 20 years.
Right.
Okay?
So how does the 60-40 fit into that?
Well, the idea is as you get closer to retirement, specifically kind of 10 years and in, maybe even 5 years and in towards your retirement age, you really need to start being a little bit more specific around, we can call it de-risking, right? However you want to phrase it, but we need to look to try to de-risk your portfolio to some degree the closer you get to retirement, because your cake is kind of baked at that point. You're kind of getting to the point where you're not going to be continuing to make money. You're not going to be continuing to save money towards your portfolios, and we have to start living off of the income. And as you start generating an income, you want to generate income from the portion of your portfolio that is not invested in stocks. So typically you're going to generate the income in your portfolio from the bond side of your portfolio, that bond allocation, which in this case is kind of that 40%. Okay. So as we start to go generate that income, yes, generally speaking, bonds are typically going to be the hedge against stocks, and it's going to generate some level of income, and we don't want them to lose value. This chart that I came across, and this did a really, really good job of illustrating the point that we've been making in conversations with our clients. And I don't know why I've not really seen this chart before. I knew that this chart was real and true, but it just provided a really, really good illustration to talk about what we're going to talk about here. Okay. This is illustrating the correlation between stocks and bonds. And I'm going to hold up the piece of paper here, but you should be seeing it on your screen. And basically what this is just showing is throughout most timelines in the history of the stock market, anything that's above the line here on the top, that's showing basically correlation between stocks and bonds is high, meaning when stocks go up, bonds go up. When stocks go down, bonds also go down. Anything that's below this line, and here at the bottom of the chart, and you can see really there's only one extended period within history, basically from the early 2000s to about 2019, where a truly diversified portfolio between stocks and bonds was non-correlated. Okay. And really since 2019, that correlation has hit all-time highs. And you can see here at the very, very end of this chart, that correlation has hit all-time highs, where the correlation between stocks and bonds has never been higher. This was dramatically outlined when you look at the performance in 2022, specifically of bonds relative to stocks. 2022, for a lot of reasons, was a really, really bad year in the market. And everyone looks immediately or thinks immediately about the performance of the stock market.
Stocks, right.
The stock market. We can call it the S&P 500. You can look at the Russell. You can look at whatever major index that you want to look at in the stock market. All of the major indices were down quite a bit. The problem in 2022 was not stocks. The problem in 2022 was bonds. Because if you had that 60-40 diversified portfolio allocation, the traditional moderate portfolio allocation, where 40% of your portfolio was allocated to bonds, the bond aggregate, the AGG, the aggregate, which is kind of the benchmark for bond performance, was down about 15%. I think it was 14% in 2022. So the portion of your portfolio that was supposed to zag when stocks zigged did not perform.
It zigged.
It all went down together, right? They all went down together in 2022.
So if I can interrupt for a second, I've heard you say this many times, and this is, quite frankly, I think you phrased this eloquently. When you say that the stocks went down, but the stocks weren't the problem. The markets are designed to do that.
Correct.
And here's what I mean by that. 2019, 2020, 2021 were 3 banner years for the stock markets as a whole. To my knowledge, off the top of my head, those might be the 3 best consecutive years ever. I mean, it was fantastic. 2022 was a down year. So the way that we phrased it before, and I've heard you say this so well, is that basically 2022 you paid for 2019, 2020, and 2021. There's a price that has to be paid.
And historically speaking, going all the way back to the beginning of the market, right? Mm-hmm. Historically speaking, 75% of the time, the markets are up, meaning 1 year out of 4 is going to be down,
and it was
basically.
Such a perfect example because it was almost a stereotype. But 2022 was not a bad year for stocks. You were simply paying the price for what you got the previous 3 years. And people who were like, oh my gosh, I've lost so much. No. Go back and look at where you were at the beginning of 2019 and look at where you were at the end of 2022 over that 4-year window. If you were in a stock-based portfolio, likely you were up big, right? You gave a little bit back in that 4th year, but over that 4-year window, you were up big. The problem was, as you just said it was the bonds. Mm-hmm. The bonds are supposed to, when the market zigs, they're supposed to zag, as you just said. They didn't. They went the same direction, so you didn't get the protection from the down market that you were expecting.
Yeah, and we're using 2022 because that's the most extreme example, and it's a very extreme example to use because the markets were down in 2022. Bonds have actually done okay in other years, but the problem with bonds is if the stocks are up, bonds may also be up, but they're never going to be up to the degree that stocks are up. That's just by nature. Bonds are not designed for return. If you're
supposed to be stable, right?
If you're a bond trader, there's some arguments there, but most people are not doing that, right? Unless you're on Wall Street and you're very, 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 very sophisticated in order to be a successful bond trader, because bond trading is a completely different animal from stock trading, and that's not the topic of this, right? But bonds by nature are never going to get nearly as high or get nearly the same level of return over the long term as you're going to get with stocks. So in a correlated market, if stocks are up, there's really no benefit to owning bonds, to be blunt, right?
Okay, all right.
Not much of a benefit anyway. Let me put it that way. Not to say that bonds are necessarily a bad investment, but if the stock market is up, if we're in a bull market, the benefit of bonds is negligible.
Okay.
Let's just say that. When the stock market's down, you need bonds because the job of a bond in a portfolio. As part of a portfolio, right? Now, generally speaking, if you want to get really, really granular, what's the purpose of a bond? It's to provide income.
Sure.
That's the idea. You're generating interest. You're generating income. That's the purpose of a single bond. Mm-hmm. But for the purposes of portfolio diversification, for 95% of all clients that we ever deal with, the purpose of a bond is diversification against the risk of the stock market. So really the main true purpose of a bond is to provide that diversification when stocks go down. Mm-hmm. Bonds at a minimum need to hold their value. Okay? That is not happening in a correlated market. And traditionally or historically speaking, bonds and stocks have never been more correlated than they are today. And this has been really happening over the last 6 years, really since 2019.
So what is causing, or do we know what is causing that positive correlation? And we've had correlation in the past, as the chart shows, but never like we do right now. What's the driver behind that? I know what I think. I want to know what you think.
So this is where you got to put a little bit of your political cap on, right? The Federal Reserve, probably in a nutshell, is the main reason why we're seeing far more correlation between stocks and bonds. Because what did not exist, and you can really go back to probably 2008 for this, but when you go back to 2008, when we had the Great Recession, we had the TARP bailout. Right. And it was like the single most unpopular piece of legislation that I think has ever existed, at least at the time. Probably since then there's been pretty bad bills in plenty of years since then too. I can
think of a few right off the top of my head. But.
Yeah, and we're not going to go into that. But the TARP bailout was specifically very unpopular, right? Because it bailed out big banks and Wall Street, et cetera, right? essentially one of the results of that was the Federal Reserve, which sets interest rate policy, monetary policy, became far more active. And we got to a point where we were waiting, and really this has become far more, and really it started in 2008, I think, where the Federal Reserve started to become far more active, but going back to COVID 2020, this really got highlighted. It really got put onto warp speed, where the Federal Reserve were waiting on pins and needles whenever the Federal Reserve chairman goes out and does a press conference, right?
Which happened this week, by the way. And I missed you being in the office for that one.
Yeah, but you were waiting on pins and needles for the Federal Reserve chairman to give a press conference and tell us if he's going to raise interest rates or lower interest rates. And the stock market in real time is reacting to those decisions. And the stock market is so correlated with the decisions of the Federal Reserve chairman and the Federal Reserve as a whole, regarding what interest rates are going to do, whether they're going up or down, that everything's become far more correlated because you could argue because of government intervention. Right. It's not a true separate and distinct market, if you will. But really, I think at its core, the reason everything has become so much more correlated is because of an active Federal Reserve.
I would agree with that. Just to make sure that everybody knows, and we've talked about this before, the Federal Reserve has one tool in the toolbox, and that's to raise what is called the discount rate. And I'll nerd out for a second. All they're doing is they're determining the rate at which the Fed loans money to banks, who then in turn loan it out and so on and so forth.
To each other. Yep.
That's all really they do. And we've joked about this before. I've got a nice big TV in my office, and I've got usually Fox Business, occasionally CNBC, and on there. And when the Federal Reserve meets every other month, which they met this week, and you were out of town, and it was like, oh, Eric would love this because it happens every time. So when they make their decision, they get up and they start speaking. Of course, this is put on TV, and if you're watching, one of these business channels, they've got tickers running at the bottom of the screen. They're showing the major indices, and then they're showing the individual holdings, typically in the S&P 500, are running underneath it. And when they made that announcement, I guess it was Wednesday this week.
I think it was Wednesday.
Yeah. Anyway,
they're holding rates steady.
Yeah, and they made the announcement that they were holding rates steady. Okay, Trump had already come out and said they need to drop it 2 points. Okay, that was not going to happen.
Which is ridiculous.
There was no chance of that happening. Whether they should or not is irrelevant. That wasn't going to happen. Most people thought they were going to hold it steady. I thought they were going to hold it steady.
And I think they probably should hold it steady.
I personally think they probably should. I've heard economists say they should have dropped it. I've heard them say that, they agreed with us, whatever. But what was interesting was they made the announcement and the market ticked a little bit. And then came the funny part, and you and I have laughed about this. We've watched. The longer the press conference goes, the more sideways the market goes. We were having a good day. It was not a great day, but it was an above average day in the general stock markets. All the major indices were up, and they were up, half a percentage point or greater. By the time they got finished with that press conference, which was, 45 minutes or so, the markets were down 1%. And the longer he talked, and you and I have done this before, we're just literally sitting there yelling at the TV. Somebody shut him up. Somebody pull the plug and stop reporting.
Like those old cartoons where they have the hook off the side of the stage.
Exactly. Just get the hook and drag him off of there. Yeah. So that is basically what we're talking about. That has become more common.
There's no reason for that press conference to even be on TV in the first place.
Well, it sells advertising, though. That's the only reason.
But the fact that we have a Federal Reserve that nobody elected doing a press conference that everybody has to pay attention to, at least everybody in our industry, right? We have to pay attention to the words of this unelected, bureaucrat, for lack of a better term, who is determining basically fiscal monetary policy for the country is absurd. Yeah. And the fact that so much relies on the decisions of a few people regarding, interest rate policy and what's going to happen. And, and this has major effects, not just on bonds. We're talking about bonds, but in anything interest rates are tied to. Personal loans, real estate loans, and anything that affects, real estate loans. Well, now you're talking about the value of home prices, and then how much of the economy is affected by the value of homes, and how much homes are being bought and sold.
And therein lies the point. Everything is becoming more and more correlated to those decisions by a handful of unelected bureaucrats. And the bonds that used to be the hedge against the stock market. When the stock market was going down, the bonds kind of held your portfolio steady, at least in part, which means you could recover more rapidly. Now they're going down with the stock market when it goes down, 2022. But to your point, bonds can't recover like stocks. Stocks can take a big hit and they can turn around and recover very, very rapidly. We've seen it many times. Bonds can't do that by their very nature. And the more the Fed is active, the less the likelihood that they're going to recover rapidly. And therein lies the problem with this positive correlation.
So if you're going back to our example of 2022, when you look at 2022 specifically, what happened to cause the extreme decline in the value of bonds? Well, there's an inverse relationship between interest rate and price or value of bonds, right? So as the Federal Reserve, because before 2022, where were interest rates? Lows, all-time lows.
Right.
I mean, virtually nothing. Anyone that refinanced prior to 2022 knows, tell me what the interest rate you have on your home loan. That's because rates were so absurdly low. They never should have been that low in the first place. That's a topic for another podcast, right? But they never should have been that low in the first place. We started to have inflation. There are some people out there that will tell you inflation was caused because the interest rates were so historically low. That's crap. That's absolutely not true. We had really, really low interest rates basically for a decade. Yep. They had been getting progressively lower, and we were not getting inflation in conjunction with it. The inflation was basically a result of the government spending that occurred in 2020 because of the COVID stuff. All that to say, we had just all kinds of inflation hit all at once. So the Federal Reserve determined that the best course of action was to promptly raise interest rates successively for a period of about a year and a half.
Every meeting, right? Yeah.
Every meeting successively. We are getting a quarter, 50 basis points increases in the interest rates. Not to say that the decision to raise rates was inherently bad. That probably, in order to fight inflation, you had to.
They had to.
You kind of had to, because you had to make monetary supply. You had to lessen the supply of money out there. You had to basically make money more expensive to access in the way of getting loans and things like that, right? And that's really the only way that you kind of dwindle the supply of money in the economy, which they did, and that's eventually what has brought inflation back down. Now, people tend to get confused when we talk about inflation coming down. We're not talking about the price of goods and services actually coming down. Yeah. We're talking about
at which they're getting more expensive.
The rate of increase, right?
Exactly.
The rate of increase in goods and services has slowed, right? So, if everything, goes up X percent, that doesn't mean things come back down X percent when inflation gets under control. When inflation comes down, it just means things stop going up at the same rate that they were. So in 2022, we had, interest rates that were skyrocketing, which in turn causes the value of bonds to plummet in a very short amount of time. Well, what has happened since they increased all of the rates? They basically held rates steady. They have not in turn decided to lower rates. They had they lowered rates.
They lowered once
or twice, yeah. But it was a small. We're still
way up there compared to where we were 5 years ago.
Exactly. And they will never go back and lower rates at the same velocity that they increased rates.
If they did, we would have hyperinflation.
And if they did, we're going to have so many other things wrong with the economy that we will still have probably more correlation between stocks and bonds. So all that to say, to your point, bonds lost a ton of value in 2022, and they've never recovered. Right. They're not even close to recovering. So if you're in that traditional moderate or conservative 50-50, 60-40 type of a portfolio, that 60% of your portfolio that was in stocks took a beating in 2022. You know what it's done since then? It's rebounded and gone up.
Oh, yeah.
Right?
Yeah, we're way up from where we were.
So we're way up, and in February of 25, we were hitting new market all-time highs, right?
Even with the downturns in March and April this year, which goes back to the whole tariff conversation, all that. Even with that, we're still way up,
way above
from where we were in 2022.
But that 40 to 50% of your portfolio that was allocated to bonds,
that hasn't come
not even close to recovering. Not even close to recovering, and it probably won't in the near future.
So let's go back, kind of bring this conversation full circle, and then we're going to talk. We're going to kind of change direction a little bit. The 60-40 you said is dead. I agree. We think it's dead because There is correlation in the markets now. It is at an all-time high between stocks and bonds. And you simply don't get the hedge from that bond side of the portfolio that what it's designed to get. And we don't know that that will ever come back and change again. So from a financial planning point of view, the rules have changed. We have to change the way we go about doing them. So my advice would be, if you are working with an advisor and you are still in a 60-40 portfolio, you should ask why. Right? Why? There might be a legitimate reason. I'm not saying that it's always bad, but why are you still in that traditional 60-40 portfolio if it doesn't really provide you the protection that it used to?
Yeah, not nearly to the same level. And there's other ways to provide that downside protection. Not to say that all bonds are bad. That's not what I'm saying. Bonds are still...
We use them all the time.
We use them all the time. And bonds still hold the place in a portfolio. But we need to be very, very specific about the way that we use bonds, and even more specifically bond funds. Within a portfolio, and not even that, because everyone, and even we're doing it right now. We're sitting here talking about bonds, and most people have no clue the level of diversification that you can get in a bond portfolio. Right? There's ultra short term, medium term, intermediate term, long term. Yep. Okay, so that's just the duration. But what kind of bonds? Are we talking about munis? Are we talking about corporate, government, treasuries?
Ran into a portfolio just yesterday that we were looking at that was just loaded with munis. And munis are short for municipal bonds, so that's bonds issued by state governments or lower level. So it could be
local governments,
cities and counties, stuff like that.
That was how Louisville financed the Yum Center. Was exactly. They issued a bunch of bonds for the city of Louisville.
And there's some tax advantages to using those, which was this can be a very, very complex subject. So there is a place for bonds. It's, to your point, it's just having a big bond fund or funds covering that 40% because that's the protection that you need. That doesn't necessarily work anymore the way it used to.
Yeah, so not all bonds are going to be created equal, just like not all stocks are going to be created equal, but you need to be very specific about the way that you're using bonds in a portfolio and to what degree.
Excellent.
and the type of bonds. Because they just don't work the way that they used to traditionally work, much like we're talking about Maker's Mark. They had to change, what they did. They had to change their philosophy a little bit around the way that they created,
right.
delicious bourbon, right? They had to go about changing the way that they did that, and they had to change the game and change some of their strategies. So too in our world, in our industry, our industry has gotten bigger and things have begun to change and become more correlated. We have to make sure that we're adjusting with the times. When I say we, I'm not talking about necessarily us specifically, because we've kind of already done this.
Right? Yeah, we have.
but the industry as a whole, and the industry as a whole doesn't do a really good job of adjusting quickly.
Most people don't like change.
Well, especially when you start talking.
Change is scary.
Well, in our world specifically, because so many advisors, you've got you have compliance teams, you have regulations, you have all these things, and you have things that have always been done the way that they've been done before. And conventional wisdom is a very, very powerful thing. And so people that have been hearing the same thing for so long, all of their lives, you build a diversified portfolio, stocks versus bonds. This is the way that people have always done it, so this is the way that we always have to do it. That's the worst excuse to continue to do something, is this is the way that it's always been done, so I should continue to do it this way. You should never use that logic to do something.
I want to transition back to the quote that I said, Bobby Bowden. I have nothing against change. I like to win too much. I remember, I want to say this was 1999. Florida State had been, I think they finished in the top 4 in the AP poll the entire 1990s. And this was a juggernaut of a team.
I was a big fan of them when I was a kid.
I was not.
The tomahawk chop, yeah.
I was not. I'm a Tennessee fan, so we had just faced them in 98, right?
Well, keep in mind, I was a UK football fan, so I needed something to...
You needed something to cheer for back then.
So I needed to find some national power, right?
But anyway, I remember seeing an interview with him. I'm pretty sure this was 99, and they were facing Virginia Tech. And Virginia Tech had this young quarterback named Michael Vick. Remember that?
Oh, yeah.
Vick played the game differently. He absolutely played the game differently. He, in a way, he revolutionized the way that the game was played.
No, he was awesome. Yeah.
His personal issues aside, he changed things. And I remember, somebody in an interview asking Bowden before the game, So what do you think about the way that Virginia Tech plays? Because you've got a quarterback now that is so incredibly mobile. He is as much of a danger to run as he is to throw. And I remember what Bobby said. He said, I don't think that's good enough to beat us this year. But it won't be too many years when there will be Michael Vicks everywhere. Man, that's the standard quarterback now in college football. Everybody, all the great quarterbacks with a handful of exceptions, they're all Michael Vick type quarterbacks. I have nothing against change. I like to win too much. And I think that's a reminder. We have to change the way that we do things from time to time. We got to step outside of our comfort zone sometimes and not do what the conventional wisdom says because times have changed. So with that, let's talk about how Maker's Mark changed and what do you think taste-wise? Because I know you've tasted traditional Maker's Mark many, many times, right? Most bourbon drinkers have had it quite a few times. It's actually gotten a little bit of a bad reputation because it didn't keep up.
Yeah, and to be clear, I like Maker's, original Maker's. I mean, I like it just fine. I like this better. I like this private select. I like this bottle a lot, actually. It's 108 proof. Mm-hmm. This was from May 2022. Actually,
has a nice hug to it. It's got not a really long finish.
It's not as sweet as traditional Makers. Mm-hmm. It's got a good finish, but it's not overbearing. A little bit of a chew, but not too much.
I was sitting here thinking when you were first talking, and I was kind of focused a little bit more on the bourbon. I was sitting here tasting. You know what? I taste molasses, which I find that to be a good thing. And, man, it is so long in the finish. And when I say finish, it's that third part of the taste on the back of the mouth and how long that flavor resides in your mouth. And then I went back and I pulled the little card here, get the readers back on so I can see this fine print. And it's explaining the different staves that they're putting in here. And remember, this one is 34210 and what they're supposed to do. So the biggest one that they've got is the second one. It's the Seared French Cuvée, and supposedly what that says is it enhances texture and mouthfeel with warm caramel notes, molasses, and a long finish. And that was exactly what had triggered in my mind, and I thought, wow, this whole compiling these different staves in here to get to the flavor that you want actually really works. It's amazing how well Maker's Mark have adjusted to being able to change their flavors. It's like I said, I think to my knowledge, they still use the exact same mash bill. They haven't changed any of that. It's one mash bill, unlike say Buffalo Trace, for example, that has 4. There's other distilleries out there that have a lot more than that. This is just their one, but they have found ways to make that one different. They even package it in a different bottle. Remember the old traditional square bottomed Maker's Mark bottle. Well, yeah, and the wax has fallen off, but they've even changed the bottle for this series, along with a handful of other ones that they've done.
The 46 as well has a different.
Well, they put the 46 in this originally, and then they did away with it.
Oh, they went back. Yeah, that's right. They did.
The 46, even the 46 cask strength, which, by the way, we will probably never review that on this particular podcast. But I am a huge fan of the Maker's 46 cask strength. It is just an outstanding bourbon. It stands on its own. It stands with water in it. I will not try it with Coke in it, but if you want to try that, it probably is good. It even makes an outstanding old-fashioned. I mean, that is a fantastic all-purpose bourbon. But I think the point in this is Maker's Mark recognized change is inevitable, and if you don't do it, you're going to get left behind. And they really have done a good job with this series in coming up with different things for different tastes.
And a decade ago, everything that we're talking about did not exist.
Absolutely. This is all fairly new.
Maker's Mark has just really, kind of entered into this new bourbon world in the last decade, really, which is when bourbon has really taken off around the world, right? But going back to our thesis, talking about kind of the traditional 60-40 portfolio, a decade ago, it was working.
Worked very well.
A decade ago, and you go back to this chart, a decade ago, the correlation, or rather the non-correlation, I should say, that was when bonds and stocks were not correlated, was a decade ago.
Yeah.
Basically between 2000 and 2019. And so the traditional 60-40 portfolio was typically working for you during those times. A traditional 60/40 worked very, very well, for example, in years like 2008 when the market had a really big crash. That's not working right now. Right. When everything has become more correlated, it's not working. You have to change. Maker's Mark changed. I think we've changed. We've kind of been probably ahead of the curve a little bit.
I was very much a 60/40 guy when I got into this business. That was how you did it, right?
Yeah, but there's still a lot of advisors out there that do not, and we see the statements when clients walk in. New clients walk in the door, and we see the statements, and we kind of keep up with everything, and we know what's going on in the world. And there's a lot of firms that are just slow, very, very slow to adapt to what has been really occurring over the last 6 years.
Right. So before we started recording today, we were talking about change and the fact that some change can be halted and probably should be in some cases, but a lot of change is inevitable. It's just the natural advancement of humankind. And if you don't embrace that and find ways to use that, you can really get left behind. And, we've been pounding on the 60/40, and we use Maker's Mark as an example, but we had several other ones. This has been all over the news the last few years. People are both in love with and terrified of AI, artificial intelligence. So, what is artificial intelligence going to be in 5 years, 10 years, 50 years? I don't know. I saw the Terminator movies just like everybody else. In theory, that's one option. I don't think that's going to happen. That's science fiction. But you know what? I was thinking, I remember 25 years ago, there was this new thing that everybody was talking about. We didn't even have a good name for it. You heard different things. And it was the information superhighway. Remember that?
Oh, geez.
And they eventually called it the World Wide Web. And I remember Tom Selleck doing an ad for, I think it was AT&T, whoever it was with back at the time, talking about what you were going to get to use this for and how cool this was. And I remember him saying, very soon, you'll get to get your concert tickets from the ATM. And that sounds absolutely archaic. We had no idea how the internet, as it ended up being called, would change the way that we went about doing things. I actually get a report on my phone every day as to the temperature in my house, and I can modify it from my phone, or the amount of chlorine in my pool, or the vacuum cleaners that are running. It's kind of terrifying.
I was in, this isn't necessarily AI, but technology. So I went to France in 2008 with my MBA class.
Yeah.
And we had to carry around these little pocket copies of the Metro,
oh, gosh.
right? Of the Metro lines. And we need to figure out, okay, well, this is the line and it goes here. And we're trying to figure out, okay, now we go here, right? Everything was on my phone. I just got back from France. Right. I was visiting my daughter who was finishing up a semester abroad. So, the wife and I, we went to Strasbourg and we went to Paris. Wonderful, wonderful trip. Had a blast. But it was amazing to me the differences between my visit to France in 2008 and my visit this year. Yeah. Because everything was on my phone. Anywhere in the city, and I'll use Paris specifically because it's far bigger than Strasbourg. Anywhere I wanted to go in Paris, all I had to do was type in where I wanted to go, and it gave me specific instructions on what metro lines to use and how to get there quickly. And it gave me directions to the metro, walking directions to the closest metro station, where I needed to get off if I needed to change trains, and then exactly what stop I needed to get off at. It even told me which direction, because typically in France, if you've ever been there, out of the metro stations, typically you can either go left, go up the set of stairs on the left, or go up the set of stairs on the right, and it basically takes you to one side of the street or the other. Okay. It would even tell you specifically what side of the street you needed to come out at to most quickly get to your destination. Completely different. I had absolutely zero problems getting around the city of Paris. It was so easy. Everything was in my pocket. That from a technological perspective, that trip to Paris was so much more enjoyable. Not to say that 2008 wasn't enjoyable. That was very enjoyable for different reasons when I was younger.
Many things were so much easier.
It was so much easier
because of the technology.
It was so much easier to get around. There was I could even scan the restaurant menus, and it immediately translated everything to English.
I was just thinking, I was on a mission trip down in Guatemala 3 or 4 years ago, and we took a little trip across a lake, and we ended up in this small town, and the poverty down there is truly amazing, but the coffee is truly, if you're a coffee snob like me, I challenge you to find something better than Guatemalan coffee. So we end up in this little coffee shop run by this family, and there is a lady there. Her name was Maria. Now, you need to understand, I took Spanish for 5 years in school. I can barely count to 10. I don't have that skill set, right? So I can't really talk to them. They didn't speak English. In fact, the Spanish that they speak is heavily influenced by Inca dialect. It's really difficult to communicate. We pulled out our phones, and Maria and I had a complete conversation. She was a joy. She ended up making me, because we were communicating, she ended up making me what is to this day the best cup of coffee I've ever had. It was a spiritual experience. But all of that is because we embraced the change, the technology that came along with what we thought at one point in time was an easy way to buy concert tickets through an ATM. But that's not the way that it developed.
I think we just found our topic for next week.
I think we did too. So
because we're gonna expand upon, because I have a lot of thoughts about AI specifically, and a lot of the misinformation that you're probably hearing in the news and on TV, and all the fear mongering around AI and what it's going to do and how many jobs it's going to cost. And I have a totally different contrarian take on where AI is going to take us and take the economy over the next, let's say, decade.
All right.
So let's just use that as a teaser for
next week. So
a teaser for next week.
What kind of bourbon should we put with that? Should it still be a random one, or do we need?
I don't know.
We need something a little bit more technologically advanced.
What's a futuristic bourbon? I don't know.
Futuristic bourbon. I'm thinking Rabbit Hole, but I'll come up with something.
You come up with something. That's your job. I just drink it. You come up with it.
So just to wrap up on the bourbon side, first of all, this is outstanding.
It is very good.
Love
Yes.
This. And it's $68 for a bottle of this, regardless of the blend. So not cheap, but not outrageously expensive either. Readily available. All the big box stores are going to have 2 or 3 versions. I stopped by Liquor Barn here in Louisville yesterday, and I think there were 7 or 8 different versions on the shelf. I just picked this one. One thing that I would tell you, if you're interested, is there's a little card that's got what the different staves are supposed to provide. If there's 1 or 2 of those that you particularly like, I would say find a bottle that has a higher number in those areas, and that's where you're going to start picking up those flavors. So just well done, Maker's Mark. This is when you embrace change, that's how you do it.
Well done, whoever Hollyfield is, by the way.
Yes. Good combination.
Great pick. So with that, we'll wrap up. Thanks for listening. Thanks for watching. Subscribe to us on YouTube. Give us a like or give us a review. 5-star rating on podcast, and we appreciate it.